Last Sunday, the US Department of Commerce quietly admitted they made a mistake. And that mistake just cost Nvidia shareholders money. Here's what happened. For almost a year, the US government accidentally allowed hundreds of thousands of advanced AI chips to be sold to Chinese companies' overseas subsidiaries. We're talking about Nvidia Blackwell chips worth billions of dollars. This wasn't supposed to happen, but because of a government oversight, it did. And if you own Nvidia stock, or any tech stock, or have money in an index fund, this just affected your portfolio. Today on Dollar Tech Hub, I'm breaking down exactly what this loophole means for your investments, your retirement account, and your wealth. Stick around. The backstory. How did this happen? Let's understand the context. The US has been trying to keep advanced AI chips out of China's hands for years. Why? Because AI technology is the future of military power, economic power, and technological dominance. The Biden administration understood this clearly. In the final days of 2024, they issued something called the AI Diffusion Rule. This rule essentially said, Nvidia's most powerful chips Blackwell, Rubin cannot be exported to China or to Chinese companies. Period. This was supposed to starve China of the chips they need. Advanced AI. But here's where it gets interesting from an investment perspective. Nvidia's CEO Jensen Huang went to a $1 million per head dinner with President Trump in early 2025. According to reports, he promised to build more data centers in America instead of China. The Trump administration liked this, so they made a decision. We're not going to enforce the Biden-era chip restrictions. We want American companies to have freedom to sell. But then this is critical. They never actually clarified what they were enforcing. The old regulations stayed on the books, but nobody updated the guidance. Nobody made it clear to Nvidia, to AMD, to companies exporting chips, what was legal and what wasn't. So what happened? Chip companies looked at the situation and thought, the government said they're not enforcing the old rule. We can probably sell to Chinese companies' overseas subsidiaries without getting in trouble. And that's exactly what they did. How much money actually left the US? Here's where this gets financially relevant to your portfolio. According to supply chain experts quoted in the reporting, hundreds of thousands of AI chips made their way to Chinese subsidiaries in places like Malaysia. Nobody knows the exact number, but let's do the math. A single Nvidia Blackwell chip costs around $40,000. Some estimates suggest hundreds of thousands were sold. Do the math. That's potentially billions of dollars in revenue that the government claims shouldn't have happened. Now, from Nvidia's perspective, this is actually good news for their shareholders. They sold the chips anyway. They got the revenue. Their quarterly numbers look better because of these exports, which is why, when the Commerce Department finally issued the new guidance clarifying the rules, on Sunday essentially saying no more sales to Chinese companies, even overseas subsidiaries, Nvidia stock didn't crash. Investors realized, we already got the money. The damage is done. But here's what matters for you. If you own Nvidia stock, or you own an S&P 500 index fund that owns Nvidia stock, your portfolio benefited from this loophole. You made money because of this government mistake. But now that the door is closing, future Nvidia revenue from China-related sales will dry up. That could pressure the stock price going forward. The real financial impact. What this means for tech stocks? Let's talk about the bigger picture. Nvidia makes approximately 20% of its revenue from China and Chinese companies. That's roughly $20 billion per year. When the new guidance closes the loophole, that revenue is at risk. Will it disappear entirely? No. But it will decrease. And on Wall Street, when a company's growth rate decreases, stock prices adjust downward. Here's the chain of events investors need to understand. Step 1. Loophole closes. Chinese companies can no longer buy Nvidia's best chips through overseas subsidiaries without a license. Licenses will be denied. Step 2. Nvidia's China revenue decreases. Let's say it drops from $20 billion to $15 billion. That's a $5 billion revenue haircut. Step 3. Nvidia's profit margins shrink because they're selling fewer high-margin chips. Step 4. Analyst estimates for Nvidia's 2026 and 2027 earnings get revised downward. Step 5. Stock price adjusts downward to reflect lower future earnings. This is already starting to happen. Within hours of the Commerce Department's announcement, Nvidia stock fell. AMD stock fell. Every chip company with China exposure fell. If you own a tech index fund, your fund value decreased. But here's the counter-argument. Some investors are saying, this is actually good for the US economy long-term. If we're keeping advanced chips away from China, that means American companies will have a monopoly on the most advanced AI. That means American companies will dominate AI for years. That means long-term growth for Nvidia, Intel, and AMD. So the sell-off might be an overreaction. This is the classic dilemma in investing. Short-term pain for long-term gain. Or is it just pain? What this tells us about geopolitics and your money. Now, let's zoom out. This whole situation reveals something critical about government policy and investment risk. Governments can change the rules at any moment. A decision made on Sunday a casual memo released over the weekend can instantly change the revenue projections of a $2 trillion company. That's how much power government policy has over your investments. Think about this from a wealth-building perspective. If you're trying to diversify your portfolio, you might own Nvidia stock, or you might own semiconductor index funds. But what you're really doing is betting that American policy will continue to favor American chip companies. You're betting that export controls will stay in place, limiting Chinese competition. You're betting that technology policy will remain stable. But this loophole situation shows us policy isn't stable. It changes. It can change suddenly. A new administration comes in, decides to enforce rules differently, and suddenly billions of dollars of expected revenue disappears. Here's what smart investors are learning from this. First, diversification matters. Don't put too much of your portfolio into any single sector that depends on one government policy. If your entire portfolio is tech stocks dependent on China being locked out of chips, you're vulnerable to policy changes. Second, geopolitical risk is real. You can't ignore it when investing. China's access to advanced semiconductors is a major geopolitical issue. It affects trade policy, military strategy, economic relationships. If you're investing in tech, you have to understand the geopolitical context. Third, watch government guidance carefully. When the Commerce Department says they're not enforcing a rule, that's a massive signal to markets. But as we saw here, it can be clarified or reversed. Keep an eye on official government statements about export controls, sanctions, and trade policy. What does this mean for your portfolio? Let me give you concrete action steps. First, if you own Nvidia stock individually, this is worth monitoring. The short term might be pressure as China revenue is cut off. The long term might be fine if AI dominance actually increases American tech companies' power. But you need to decide. Do you want to hold through the pain, or do you want to take some profits? Second, if you own a tech index fund or an S&P 500 index fund, you already have exposure to this. You don't need to do anything. Index funds are designed to weather policy changes. You own a piece of hundreds of companies, not just Nvidia. If Nvidia struggles, other companies might benefit. That's the point of diversification. Third, if you're thinking about investing more money right now, this is worth understanding. Some investors see a 10 to 20% drop in tech stocks and think opportunity by the dip. Other investors see it as warning, stay out. There's no right answer, but you need to know what you're buying into. Here's the bigger financial lesson. Government policy is an investment. Every time the US government restricts chip exports to China, it's essentially saying American tech companies will have a monopoly on the highest margin chips. That's worth billions of dollars. But that monopoly is fragile. It depends on government staying consistent and government changes. This is why diversification isn't just about owning different stocks. It's about owning exposure to different government policies. Own some US tech stocks, but also own some international stocks that benefit from different policies. Own bonds so you're not 100% dependent on equity markets. Own some commodities or real estate so you're not dependent on technology policy alone. What happens next? TA Outlook. Here's what we're likely to see going forward. 1. Nvidia and AMD will shift their strategy They'll either try to sell legal versions of chips to China lower-powered chips that meet export control standards, or they'll invest more in the American market and Asian allies like Japan, South Korea, and Taiwan. That's where their growth will come from. 2. China will accelerate its own chip development. Companies like Huawei are already building their own chips. The export controls actually motivate China to become so paradoxically, keeping advanced chips away from China might accelerate China's ability to make its own advanced chips. That's bad for Nvidia long term. 3. Watch for more government clarifications and policy changes. The Biden administration changed rules in the final days. Trump changed them in his first 100 days. The next administration will probably change them again. This volatility is going to continue. 4. Other countries will try to position themselves as alternatives. If the US restricts chip exports, maybe the EU can build its own chip industry. Taiwan might become more important. India is positioning itself as a chip manufacturing hub. Watch how American technology policy affects these geopolitical shifts. From an investment perspective, this means stay flexible. Don't assume current policy is permanent. Be ready to adjust your portfolio if export controls change again. And remember, government policy changes are one of the biggest risks to tech sector investments. Closing. The call to action, here's the bottom line. A government loophole that lasted a year just cost Nvidia shareholders tens of billions in expected future revenue. But it also generated billions in past revenue that already happened. This is how government policy works. It creates winners and losers in an instant. As a personal finance investor, you need to understand that policy risk is real. You can't just pick stocks and forget about them. You need to understand the geopolitical and regulatory context. You need to understand that governments can change the rules. If you're building long-term wealth, diversify across different policy exposures. Don't bet everything on one country's technology dominance. Don't bet everything on one company, and definitely don't bet everything on policy staying the same. On Dollar Tech Hub, we talk about building wealth through smart decisions. And one of the smartest decisions is understanding that government policy changes. Plan for it, hedge against it, diversify because of it. What do you think? Are you holding Nvidia stock? Are you worried about tech sector exposure because of government policy risk? Drop a comment below. And if you found this breakdown helpful, subscribe to Dollar Tech Hub for more deep dives into how government, economics, and personal finance intersect. See you next Tuesday.